It's Chris Doherty, Doherty Properties, coming to you to talk about the federal government slowing down buying bonds in the real estate market and potential interest rate increases in 2022 and what that means for you in the housing market. We're going to answer that today. The Federal Reserve has indicated that it is going to slow down the amount of bonds that it buys in the real estate market, and it's signaling up to 3 increases in interest rates in 2022. And the question is, why is this happening? Well, all of us are seeing an increase in pricing in all areas of the economy, from the amount of money you're paying on food, to gas, to oil, to housing. And so one of the things that the government has been doing to help stimulate the real estate market is buying mortgage-backed securities. And by doing that has been helping these interest rates be lower by also keeping the interest rates at a very low rate. But because money has been so inexpensive, it has caused the rise in asset prices, and that is the residential housing market. And so because prices keep climbing at this rapid pace of 20%, 18%, the federal government is saying, okay, we feel like at this point we have a housing recovery and we don't need to keep giving money to stimulate this part of the economy because we feel like a recovery is there. So what does that mean for you if you are a home buyer, if you are a home seller, if you're an investor or a builder? It means that right now, the federal government is trying to figure out how to control housing costs in the United States and slow the growth of these price jumps that are happening. And so the way that they're going to do that is slow down the amount of stimulus that they put into that market, in the hopes with that and rising interest rate that they can stabilize pricing and then bring pricings back down to normal levels. This will have an impact long-term on pricing. I always say when interest rates go high, asset prices go low. When interest rates drop, asset prices climb. The only thing is that we are in a very aggressive price appreciation market, and we still have a housing shortage. And so what I anticipate is going to happen is interest rates are going to climb over the next year. Right now, we've been hovering in that 2.75 to 3. I think by the end of the year, you're likely looking at a full point increase in the interest rates in the United States. You're probably going to be hovering around that 3.75 to even 4%. This will start to slow down some of the price jumps, but it's going to take time, okay? Because to get control of inflation, to get control of pricing, it takes time, and there's been a lot of speed and momentum and a lot of money being put into these markets that it's not going to happen overnight. So what you're likely to see in the first to the final quarter of 2022, interest rates at a much higher rate, and elimination of the bond buyback program that the government has been doing as a result of the COVID-19 pandemic, and a stabilization of the U.S. housing market. So there still is very little inventory on the market. And one of the challenges is you have this low inventory and the prices are jumping. You're still going to have this low inventory for sure. But now they're trying to control the prices so they're stable and you get normal growth, okay? Instead of getting 20%, can we get back to normal appreciation, 2%, 3%, 4%? Now, the last time that we went through this as a country, and they started to do tapering, and we saw mortgage interest rates increasing, we still saw appreciation of around 10% in pricing. So I don't want you to think like, okay, all of a sudden, this is the end, the market's coming to an end. That's not going to happen. This is a process that takes time, okay? It's like taking a big ship that's in the ocean and you want to turn it. You just can't do a quick 180. It takes a lot of time until you can get that turnaround and slow down the appreciation. So you will see price stabilization where things will start to normalize and you'll have appreciation growth at a more normal level, but that's going to take 12 months or more would be my guess, okay? So big doings in the housing market. I think because it's a supply and demand market, there's still no supply, you still have a lot of demand. Even if interest rates jump up a point, you're still going to have demand because it's such historic low rates. Going up to a 3.75 is still such a low rate. You're still going to have a market, but it will help start to stabilize pricing. So, Chris Doherty, hoping you guys are having a great week. The real estate market continues to be strong and vibrant. I look forward to seeing you guys soon.